Vice President, Global Asset Allocation, Societe Generale Research. Praveen, thanks so much for joining us this morning. And it looks like, you're definitely seeing a shift towards EM equities now. Talk to us about, why they're perhaps looking as a more attractive opportunity currently, and within that as well, how strong India's potential is.
Yeah, so what we have seen in recent past is that EM equity has not performed that well, and there has been some underperformance, especially relative to US equity market. So broadly, if we look at our asset allocation stance, we are underweight on equity. And within that, we are gradually liking EM equity more. And within EM equity, we have definitely preference for China domestic equity markets and Indian equity. And one of the reasons why we have preference for EM equity at current point compared to other equity markets globally is we are seeing a very low growth, low inflation environment, and growth expectations globally are coming down. However, even in that kind of scenario, EM economies will still grow at a much faster pace. So given the underperformance of EM equity and the valuation, we feel that EM equity could be a good opportunity. Our asset allocation work that we have done, and we have done asset allocation at different phases of the economic cycle, and we have observed that in a phase where recession risks are rising, yield curve is inverting, along with US equity, EM equity acts as a good portfolio diversifier. So that is the reason why we are positive on EM equity, and within EM equity, particularly China and India.
Let's also talk about what's happening with respect to the yields. We've seen the US yield curve inversion, which has only deepened, and that seems to be rekindling those fears of that looming recession. What exactly is your outlook on the yield curve, and do you think that this sort of safe haven demand towards the bonds is only likely to continue? I believe there's some sort of a strategy, yield and shield, that you're talking about.
Yeah, so that was our earlier publication in March, and since then we have focused on government bonds because cyclical risks are rising. Right now, what we are seeing globally is that a large portion of the global debt market is yielding negative yields. So that is creating extreme pressure on anywhere where yield is even moderately high. So that is why we saw US Treasury yield falling very sharply. US Treasury bonds have given around 12% return year to date, which is quite high given the level of yield. And this pressure is going to remain there. So that is why we have a preference for government bonds, and what we have seen over the last few months, this type of yield curve behavior indicates a recession going forward, and in that kind of scenario, we from capital preservation purpose also, it is important to have bonds in portfolio. At the same time, within EM universe, we have preference for Chinese local currency government bond as well as Indian local currency government bond. We have seen a very sharp decline even in Indian government bond yields over the last 2-3 months. And we are likely to see further pressure on the yields over the next 12 months or so.
Okay, fair enough. Let's also talk a little bit about some of the concern that is looming large with respect to the recession in the US. Do you believe that it is a little bit premature, that the data points, if you gather them together, don't really indicate that we will actually see that? Or by way of what the yields are showing, there is some sort of a definitive trend? And how detrimental would this be for some of the other global markets, including our own markets?
Yeah, you're right. If you remember, we had some correction over the last quarter of previous year, and at that point in time, the behavior of bond yields was completely different. What we have seen over the last few months is very sharp fall in yields, and it has certainly to do something with the recession fear in the event of escalation in trade war tension. So what we are seeing is news flow around trade tension is deteriorating all the time, and global trade outlook is deteriorating, and that could trigger a recession earlier than what was being assumed even few months ago. So there is our base case scenario from global economy perspective. We are expecting a recession next year in US, and that will have implication for equity markets as well as bond markets and asset allocation.
Okay, fair enough. What about, the kind of political deadlock or the lack of stimulus that we're seeing as well in the European region? Can you give us a sense as to whether some of these pressures are only likely to escalate? What's the view there?
Yeah, so there are political deadlock, and there is a big fear in European economy about Japanification of Europe. We are already seeing the yields are very negative in Germany and in some other European countries. The question is political deadlock as well as how much stimulus can be provided, which will have an impact on the market. So we expect the scope for further easing there, given the very low level of yields, and whether that stimulus will have a big impact on the economy as well as on the market, it's somewhat suspect.
So, considering that you are thinking that perhaps the dollar is now starting to look a little steep, would you be moving more towards the euro? How would you be playing things on the currency side?
Yeah, so if you have a portfolio which is denominated in euro, the return from fixed income assets, currency plays a very big role. So in that kind of scenario, if you from fixed income assets, probably there will be some movement towards euro denominated asset, and that is one reason why we are more positive on euro corporate debt compared to US corporate debt. But we also need to think from equity market perspective. Weaker dollar means it will be difficult for euro area companies in that kind of environment. So how we will position ourselves in equity and fixed income will diverge in the event of dollar weakness.
When you're talking about local currency bonds with respect to China, what's giving you confidence there? Just talk us through the rationale. Is it because you're expecting China to support, of course, the monetary environment, or are you expecting things to play out a certain way with respect to the current debt situation as well as the US trade wars?
There are a couple of factors there. Globally, there is a huge hunt for yield. There are only few markets where default risk is very low and yield is reasonably high. So China is one of those markets where yield is reasonably high. The other factor is definitely we expect that there is scope for Chinese policymaker to reflect, and that can have impact on bond yields. And another factor that could support Chinese government bond is their more inclusion in global benchmark bond indices. So that will also lead to some passive flows into those government bonds. So a combination of these three factors make us more positive in Chinese government bond. And another reason is we feel that though there has been some pressure on currency recently, but it is going to be rather stable. So that is why we feel positive on Chinese government bonds.
Okay. For an Indian investor, though, Praveen, what's the right strategy? Because when that impending recession does hit US, it's going to take us as well in the storm.
Yeah, you are absolutely right, and that is what we have seen also over the last few months, and historically also it is very difficult for flows and Indian equity markets to do significantly better when there are outflows from the equity globally. Right now, from asset allocation perspective, India on a relative basis compared to other emerging markets, India is definitely one of our preferred markets. But from domestic investor perspective, if you are looking at Indian equity and Indian government bonds, probably one can get a return of 9 to 10% from government bond over the next 12 months without much volatility. However, the same cannot be said about equity. So we need to be a little cautious. Government bonds present very good opportunity. In equity also, we need to get some more clarity on trade war related news flow and look for opportunities where we can be very aggressive. Our asset allocation work on India suggests that in an equity and bond portfolio, one should have around 55 to 60% equity on an average most of the time. And when the equity valuation improves, right now equity valuation in India is good compared to bonds. Equity risk premium is reasonably high. However, over the last few weeks, we have also seen volatility going up. So in that kind of environment, a more balanced allocation between equity and bond is preferred in the near term.
Thanks much for taking time out and joining in, sharing with us your outlook on the bond yields, the global recession fears, as well as how you're looking at emerging markets.